Good afternoon, everybody. Good afternoon. Good afternoon. Okay. Alrighty. Welcome, everyone.
Hey there.
Hey, what's up?
What's up, Grace, Harlan,
Hey there.
Michael?
Hey, how you doing?
Albert, what's up?
What's up?
Okay.
I'm at work, so my picture go in and out because I'm at work. So
Hey, no worries. No worries.
Okay.
We will be having today recorded, so um we'll make sure that everything goes up into the classroom if there's anything missed.
Okay. Oh, that school email. If you could maybe resend it to me because it wouldn't open up the school for me. I don't know.
Okay.
Something happened or something. I don't know.
All right, Albert.
Thank you so much.
Well, what sometimes happens, and just as you guys are coming in here, has everybody gotten into the school group?
Yes.
Yes.
All right, Daphne. Okay. Okay. If you haven't gotten into the school group, just make sure that you do shoot us an email back. What sometimes happens is people created a school group with another email than what they signed up for the boot camp in, and then it's like the the school group invitation went to a different email rather than what you log in there. That's happened a couple of times, but either way, we'll get you in there.
Okay. Thank you.
Also, it's technology, as advanced as we are, shit happens. Okay. Daphne, you didn't get it? Salter. Okay. Salter, I thought we tagged each other in comments on the school group. So we should. Okay. Alrighty, guys. So we are getting started here. And first of all, I just want to make sure that you guys have my sincerest thanks for investing your time and your money into learning more about this business. My hope is that by the end of this week, you will have a deeper understanding of the BRRRR strategy, how you will be able to help your clients build and scale their rental portfolios, and how to make this business work for you, whether that's fitting it in as uh, another income stream in your existing business, or if you want to pivot into this full time, that you can see the roadmap to being able to do so. There are some time constraints. We are doing this from 1 o'clock to 2 p.m. Eastern every day this week. So, uh, from Monday through Thursday. So I want to be able to maximize the amount of time that we have together, but understanding that if there's stuff that we don't cover, I want to make sure that we get that at least as an auxiliary resource put up into the school group. Okay. So moving forward, if you guys have questions, I want this to work not like last night's webinar or any other webinar. I do want this to be an active discussion, but we're going to try and hit the answer as quickly as possible and move on. I have a study guide that will help us map out at least the core highlights of what we want to get to throughout the week this week. That is in the classroom in the mini course section on day one. You can grab the study guide. But this is what I'm going to be using to make sure that we hit all the topics that we're looking to cover this week and get as much detail in there as possible. So my goal for today is to hit through at least 1, 2, and 3. Tomorrow we'll get to more of the loan process. So we'll skip to 6 and 7. Then we'll day three is more about the marketing, how to find borrowers and how to find lenders. And then day 4 is going to be common pitfalls and building a business. All right, so that's where we're going with that. So just polling everyone in here, who here already is in the real estate game, whether you're a real estate investor or you're a real estate agent, you might already be a mortgage broker or a loan broker right now. Go ahead and put that in the chat. EJ was previously an agent. Perfect. Justin's in the game. Louis is a loan officer. Perfect. Grace is a real estate agent. Michael's a broker mostly. Fantastic. Justin's a realtor. Jessica is a wholesaler. Okay. So I do want to make sure that if there's anyone that is not familiar with the real estate transaction, that we don't let them fall behind. So let's quickly go over the real estate deal. And if you guys, I'm going to ask you to mute if you guys have it on, and then we'll let you guys talk when you do have questions at the right time. Real estate investor, lending private money. Okay, Albert, fantastic. Maybe we'll all be broker into Albert. Maybe this is where we're going to get all our money from. Okay, so real estate is a game of relationships. Okay, and it is a game of making sure that our clients, which are borrowers, we're calling our clients borrowers. A real estate agent will call their clients buyers or sellers. And insurance agents will call their clients insureds. There's different terminologies, but we have to focus on our borrowers. Okay, so our borrowers are real estate investors. They're looking to buy properties to fix them up and flip them, or they're looking to fix them up to hold them as rentals. This is different than John and Susie Homebuyer. This is different than the retail sale. Okay. This is a business. And that's why I like being in this business, is because it's not the highly emotionally charged John and Susie Homebuyer. This is about getting a job done. And when you approach it that way, it makes the conversation not only between you and the borrower, but you and all of the other players involved a lot more simpler. And if you are in a project management role already, or a transaction coordinator, or if you're working with a larger company and you're working on group projects, that is what we are involving ourselves with. And we are taking the seat as a quarterback. Okay. So what does a loan broker do? We are the plug. We are the ones that people call when they need money. We are also, in my opinion, the most important person in the entire transaction. The reason being is that we're responsible for getting everyone paid. We're responsible for making sure that title is paid, real estate agents are paid, wholesalers are paid, everyone along the line, even down to contractors based off of the scope of works that they provide. Our lenders that we work with are paying out draws that eventually go to the contractors. So when we take the responsibility and we own that responsibility, that we are the most important people in the transaction, following the new golden rule, who has the gold makes the rules. That allows us to approach any conversation and all conversations with a certain perspective of qualification, making sure that everything is lined up. Because while at the same time, we are the most important person, we are also only getting paid once the deal closes. Okay? And we're getting paid based off of the loan amount. So when you approach a $100,000 loan versus $1 million loan, you effectively should, doing business right, you should approach them the same way. But when a client comes to you and there is a different type of client that's going to approach you that's looking to do $100,000 deal versus $1 million deal. And your goal as a loan broker, at least up front during the initial sales conversation, is to sniff out what kind of borrower they are. Okay, so the real estate transaction. We are looking for real estate investors that are buying properties at a discount. Is everyone familiar about with what a distressed property is? Okay. So a distressed property is not, it doesn't always have to be the physical property itself, but it also will be about the seller situation. It could be financial. Exactly. So the seller is facing foreclosure or they've inherited a property. They're an out-of-state owner. They're going through a divorce. They owe back taxes, code violations. There's any number of things that can indicate distress. Now, in the wholesaling game or the real estate agent game, then you're working directly with those sellers and you're looking to help them sell their property. Well, and also with it being a real estate agent or a wholesaler, you're recognizing what the property is worth today and then what it will be worth once it's all fixed up. As a loan broker, having that foundation and basis of knowledge is imperative to be able to evaluate a deal quickly and what product we have that will be able to help our clients achieve their goals, whether that's to fix and flip a property, to BRRRR a property, or buy a property that's turnkey. So the tools that we use, if you're looking to do this as a zero ad spend, zero marketing budget, as low cost of tools as possible, then you can use free tools like Zillow and Redfin and Realtor.com to be able to evaluate the when you are looking at a purchase agreement, whether it's a discount, and then evaluating comps on what a property will be worth once it's all fixed up. That's the after repair value. So it starts with a distressed seller buying a property and our borrowers looking to buy a property at a deep, deep discount. We're aligning ourselves with the BRRRR strategy so that we can develop clients rather than chase deals. Wholesalers chase deals. Real estate agents chase deals. We're developing clients and we're using our qualification skills to understand where the baseline is of where our clients are, understand their goals of where they want to go, and use our tools to help them get there. Okay? That being primarily hard money and DSCR loans. If you guys are already in the credit funding space or other types of loan brokering space, this is how you can really weave in these two other products to help your clients get that 100% funding feel without them going to private lenders to go and get 100% funding. Okay. Questions so far about who a loan broker is and what we're doing? None? All right. Great. So last night and in the webinar, we did cover a good amount of, what this business looks like at a high level. And that's important. But right now, we're going to dive deep into some specifics. What I learned from the last boot camp is that I didn't do enough about going into the X's and O's of hard money and DSCR loans. So we're going to jump right into that. First off, has anyone ever used a hard money loan to fix and flip a property or used a DSCR loan to refinance or purchase a property? Nobody? Okay, cool. Cool. So what is hard money? Hard money is a real estate investing. Oh, by the way, guys, uh, Harlan's already in the Broker Elite program. So this is something that we're working on together. But anything that I say in here, any phrases or phraseology that I use, you feel free to rip me off. Okay? This is something that I try to talk to like an eighth grade level so that when I'm interacting with clients that don't know anything about what hard money or DSCR loans are, that they're able to come away from it knowing more than when we went into the conversation. So when I talk about hard money, I try to stay within the same phraseology about it. I reference things as tools that real estate investors use, and then I talk about the specific use case of them. So when you go and you're borrower facing, I would encourage you to use the same. Put your own little spice on it. Make sure that it's coming from you. But when you're talking about tools for that you sell, make sure that you're highlighting what their use case is, what their pros are, mix in what they're not for, and then why your solution helps them get to where their goals are. Okay. So hard money loan is a real estate investing tool that real estate investors use in order to be able to buy, fix, and flip properties, as well as buy, fix up properties to rent. They get money towards the purchase price and up to 100% of the rehab budget reimbursed to them as they go through the milestones of the project. They're short-term, high-interest loans that they don't want to be in very long, but they allow you to close as quick as cash without having to provide any proof of income or tax returns to qualify. And since their business purpose, they're not reporting on your personal credit. Okay. So the first thing that anyone's going to ask you is, what's the rate? What's the interest rate? And we're not beating around the bush about hard money. It's a short-term, high-interest loan that you don't want to be in very long. Okay. So when someone is trying to say, oh, hard money, isn't that expensive? You say to them, yeah, it's a short-term high interest loan. You don't want to be in it very long, but you are able to close as quick as cash without having to provide any proof of income or tax returns to qualify. And it's based off of the deal primarily with a blend of your personal credit based on experience. Okay. It's interest only payments. Okay. The reason why the interest rate is high is because of how long the borrower is looking to use it and its repayment, how the lender's actually getting paid on it. It's interest only payments rather than principal build back. Okay. It's paid off by either selling the property or getting the property refinanced. That refinance is when we help them get the DSCR loan. The average term for a hard money loan is going to be anywhere from 6 to 12 months. They can be as long as 24 months, even 36 months on, big capital projects like building skyscrapers and apartment buildings can be on like 3-year bridge loans. But for single family 1 to 4 is what we're focusing on. It's going to be 6 to 12 months. This is one of the most important slides that we're going to have today, and this is the letter salad. LTV, LTC, ARV, LTARV, and then DSCR. DSCR, we have a whole presentation about DSCR. But the loan to value, that's what the property that is based on what the property's worth today. A loan to value is what a lender will lend on a property based off of its appraisal today. The loan to cost, the cost is the purchase plus rehab number. Purchase plus rehab is total cost. So the loan to cost is how much a lender will lend towards the total cost of a project. The after repair value is what a property will be worth once it's all fixed up. That's what the comps show. The loan to ARV is how much a lender will lend towards that after repair value. And each of these different letter style, these acronyms are references towards guidelines that our lenders use in order to determine how much money is actually going to be on the loan and how successful a project will be and what the requirements will be for a borrower as far as cash to close, what they need to bring as far as cash to close. So how much can a borrower actually borrow towards a project? Well, the typical down payment on a hard money loan is going to be 10 to 25% down. So if you're talking to borrowers and you're letting them know about your different products, you phrase it based off of their experience. Okay. Based off of your experience and credit and what the deal looks like, it could be anywhere from 10 to 25% down. My clients with a 700 credit score or higher, even newbies can be approved for 10% down. All right, guys. So that's my phraseology. That's how I talk about my loan products. You can feel free to totally rip me off there. The max loan to cost is 80 to 90%. Okay, so what does that really mean? If you guys can see my calculator, just let me know. So if you're buying a house for $100,000 and your rehab budget is $50,000 and you have a 80% loan to cost, that means that you multiply that number times 0.8, that's 80%. Your max loan amount based off of the loan to cost guideline is $120,000. What does that mean as far as what a borrower is going to be bringing to the table as far as cash? You take out that $50,000 that as far as the rehab budget, because we're looking for 100% reimbursement on the rehab. Now, what do they need to bring? They have a $70,000 purchase advance. That's their loan to purchase. That's their loan to value. Over $100,000 purchase price, that's 70%. That's a 30% down payment towards the purchase price. Okay, so 80% loan to cost, they better have a good amount of cash available or access to cash. 90% is more typical with the lenders that we work with. So in that same scenario, 150,000 times 0.9 minus the 50,000 over $100,000 purchase price. That's an 85% loan to purchase, 85% loan to value. That's a 15% down payment towards the purchase price. The other guidelines are max loan to ARV. So that same purchase and rehab budget, that same total cost, when the property's after repair value comes in at 225,000, then the max loan amount that they're going to be able to have, if that's at 75%, that's their max loan amount. Okay, well, why can't they borrow 100% of the deal if their loan to ARV is at 168, well, this protects the lender's position and requires the borrower to have skin in the game. So they'll default to the loan to cost. There's other scenarios where it's inverted. And the lender's going to go based off of the lesser of the two. Okay, so if you haven't already gotten into the school group, when you do get into the school group, then on the pinned post is the exclusive lender guide. If you guys purchase that ahead of time, then you got it emailed to you. But here's the exclusive lender guide. It's also in the mini course section. And here is where the basic loan to ARV and loan to cost and general loan to value guidelines are for each of the lenders that we work with primarily. We have Kiavi on here, we have Easy Street Capital, and then RCN Capital. All right. By the end of your assignment for today, when we break out of here, is that you guys need to go get that exclusive lender guide. That's where all of those lenders hyperlinks are, and then go to those lender websites and sign up for their broker program. If you don't already have a business entity set up, I would advise you to get your business entity set up, whether for this or something else. Kiavi may work with you as an individual, but when you get paid on the settlement statement, it's going to say Gary Brown on there, or it's going to say Michael Giordano, or it's going to say Mark Martin on there. Okay. Unless it's your business entity. So if you're working with a client and you're brokering the deal, your origination points and what have you, if you're making a $3,000 fee on a $100,000 loan, that looks like 3% just to you. You know, Kiavi may be at another 1.5 or 2% on that same deal. That's 5 points total. They may turn back to you and say, EJ, you made $3 grand on this. I don't know about, like, it says on the settlement statement that you're making $3 grand. I don't know how I feel about that. It's just like in wholesaling. Like, do you always want your buyer or to know how much you're making? Do you always want your seller to know how much you're making? Now you can have your entity as the origination company making that. That's really the only that is how it will work if you guys are in the broker programs for these lenders. You're going to get paid on the settlement statement. As you start to do more deals with them, then they'll offer you to be in their TPO program, which is the third party originator. So TPO. So let's just make sure that we have that. So you go to the exclusive lender guide, you click on the hyperlink. All right, well, this goes right into it. So incognito, can you guys see my screen? Okay. So over here is programs partners. So you go to the broker program and then you go and you click around and you join now. You fill out their form. It'll walk you through it. And I want you to do that for each of the lenders that are on there at least. Okay. I helped a client with a DSCR as a realtor. Awesome, Grace. I purchased the exclusive lender guide separately, but I don't have access. EJ, okay, let's fix that when we get off here. Make sure you shoot me an email. Okay, so we covered a lot so far. What questions do you guys have so that I know that we're not you missing anything? Guys, it's gonna be a lot of me just yapping if you don't have any questions.
Hey, Gary,
Hey,
this is
Brandon.
Brandon.
Hey.
Do you mind going over that the funding scenario again, where you said that like it was like 100,000, and I think it was 50,000 was
Sure.
um, I just wanted to be sure about what the actual down payment was. I saw you did the numbers, but we didn't actually say what the down payment was. But
Sure.
Mhm.
Okay. So let's work this through Kiavi. Okay. So Kiavi allows for 90% loan to purchase and up to 100% reimbursement on rehab when the borrower has a 720 credit score or higher and their algorithm approves the location. So say it's everything passes with the location and the borrower. They have a $100,000 purchase price and a $50,000 rehab budget. We're going to have to know what the property will be worth once it's all fixed up in order to lock in what their down payment will be, because they're based off of a max loan to ARV at 75%. So in the scenario where there is a $225,000 ARV, the max loan amount from Kiavi will be 168,750. Now, with our total cost being below that, $100,000 buy price, $50,000 rehab, then we're going to default to where they're at as far as their loan to value purchase and 100% reimbursement on rehab. So they have a $100,000 buy price. Their loan to value guideline is 90%. So that would be 0.9. That means that on a $100,000 purchase, they have a $10,000 down payment. Does that make sense?
Makes sense.
Okay. In the previous scenario, we were talking about where it would just be a 90% loan to cost. Okay.
Mhm.
So 150,000, 0.9. That would be the guideline is loan to cost. We have $135,000 total loan. You take out 100% reimbursement on rehab, that's automatically going in there. So that's 50,000. So now they have an $85,000 purchase advance. 85 against 100, that's a $15,000 difference. That's a $15,000 down payment.
Okay, it's just a little different than residential mortgages, right? So
Oh
you,
yeah. Yeah, this
yeah,
is totally different. Yeah.
yeah. Okay.
Okay. I saw that there were some questions coming through. Michael, thank you for putting that through.
Directly
Is that
to
from, if
you,
this
so I
is,
don't know if you wanted to share it with everybody. It's up to you.
yeah, when you guys sign up with their broker program, they're going to share most of this stuff with you. Um, but the thing is, like a lot of this changes like all the time. Uh, not the licensing requirement. Okay, Kiavi works in select states. You need a license to broker with them in California, Arizona, Nevada, North Carolina, and New Jersey. Outside of those states, you can work with them as long as they operate in those states. Okay. Yes, Grace, exactly. So credit is the biggest influencer on the loan to value purchase as far as Kiavi is concerned. But for other lenders like Easy Street Capital and RCN, it's about experience. So what we call experience is when a borrower has been on title when the property was purchased and when it was sold or refinanced. And then it's going to be a look back period of a max 36 months. So a rolling 36 months. So right now, if we were looking to qualify a borrower, I would phrase it, say, hey, what does your recent experience look like going back to May of 2022? We want to be specific about that because if you're working with RCN, then and you give them a experience track record, and they have a flip from that was sold in January of 2022, they may look at it, but per their guidelines, they're going to say that's not recent enough. But in general, the tiers are 0 to 3, and then 5 plus within a 36-month time frame. There are other lenders that have different ranges of it, but in general, when I'm looking at most nationwide lenders, it's going to be 0 to 3 is in one bucket, 4 to 5 is maybe another bucket, and then it jumps from 4 to 5 to like 10. They don't do another pricing break until 10. Kiavi's definitely the highest leverage lender that we work with that's one of our partners. But they are very strict about their credit box and their deal criteria. So having other lenders available and not just selling towards Kiavi's terms allows us to be better brokers. And I'm constantly trying out different lenders for different scenarios and adding them in here. But as far as starting out as a broker and really understanding the guidelines and allowing us to charge the best pricing, Easy Street Capital, RCN, and Kiavi are going to be the best to use for now. There's also Finance of America Commercial, and then Velocity Mortgage Capital for more commercial properties. But those individually have Finance of America Commercial is really the same as RCN. I don't see a whole lot of differences in their product or processing timeframes. But Velocity Mortgage Capital is if you are directly coming in contact with more business owners that are looking to buy um, commercial buildings, light industrial warehouses, or if you're coming into contact with people that have properties free and clear and don't want hard money, they'll do a 50% LTV product uh, without without any credit minimum. So we'll talk about those in later modules, and I'll get them in the school group. Okay. So we're still talking about hard money. I want to make sure that we wrap up and get with DSCR loans before the end of here. But any questions about hard money right now? Okay, do we feel confident that we can talk about hard money and how it's priced if we were to work with a borrower right now? I know Michael's shaking his head yes, but I can't see anyone else shaking their head when they don't got their camera on. All right. Salter, you getting everything here? I know we talked on a one-on-one call.
Yes, I am. I am. I'm very familiar with all of this material.
All right, cool.
Thank you.
All right, so we're getting paid on points. How do we price ourselves effectively on a hard money loan? This is really the sauce. You have to figure out what your time is worth and how and what types of deals and borrowers you want to work with. Most of what we're doing is email communication and collecting documents and quarterbacking a deal to close. We're not laying bricks. We're not tarring rubber roofs in the middle of the city. This isn't heavy labor, but we do have to be firm in what we deliver to people, and we are responsible for sharing with people what the cost is going to be to get into a real estate project. There's a lot of responsibility associated with that. So, and that's why our expertise is demanding commission. So I like to make $3,000 per deal. So what that means is that on a $100,000 loan, I may be 3 points with a lender base at 1 point, and with our relationships, that's a 4 point loan. Nationwide average is 2 to 3 points on a hard money loan. There are other lenders that will do lower loan amounts, and then you will see things like 4 to 5, maybe even more points, depending on how what the loan amount looks like. And then on the other end, there are some higher loan amounts where they're still at 3 to 4 points, just because that's how the lender views their expertise and how they deliver service on the back end. So you're going to have to figure out what your number is in your head on what you'd like to make per deal and what your effort is worth to getting a deal to the finish line. Any question about points or how to price your service? I recommend not going lower than 2,500. 2,500 is respectable for this. Hey guys, don't flirt on the chat here, guys. Oh my gosh, you look familiar. Okay. So DSCR loans. DSCR loans are what we use as brokers in the BRRRR strategy to pay off the hard money loans. The property's got to be in rent-ready condition. The property is going need to appraise for the target ARV that we were looking for on the front end or higher. And on that appraisal, we're going to need to verify what the fair market rent is for the area, and that's how they're going to base their cash flow. Debt service coverage ratio is the fair market rent over the fixed expenses. Albert, do you have a question?
Yes. How do you verify the market rent?
That's a great question. So, if you don't have tools like like access to the MLS, you're gonna want to use the free tools like Zillow and Redfin and Realtor.com to see what the listing for rent are. But ultimately, you're hoping that if the property's leased out to a tenant, that it's at least close to what market rent is. Because the default is they're going to use the lesser of the two, whether that's fair market rent or what the actual lease amount is for the property. Great question, Albert. I'm going to pull up the DSCR loan presentation. And by the way, guys, I go into depth on hard money and DSCR loans in specific terminology, more on the letter salad and how to evaluate a deal in the hard money and DSCR loan basics course, which is inside the school. So we're keeping it tight to an hour here. There's auxiliary resources, so go in there, make sure that you guys review that. Gary, what is this multiplier I hear about to see if a deal is good for a DSCR? Don't, there's a lot of bullshit. Okay. It's fair market rent. No, no, nobody say 1% rule, 2% rule. This isn't 2016, 2015. No, that's all out the window. We're in a high, elevated interest rate environment. We need to go straight by the books. What's the appraisal value of the property? What's the fair market rent for the property? And we're targeting a 1.0 or higher for approvals, but we are making sure that the when the calculation does come through, if it's a 1.15, that's where we have a better chance of having underwriting approval without any extra conditions. By the way, also, uh, we're doing weekly uh, calls on Wednesday from 3 to 3:30. We've had a couple so far. And sometimes it's me and one other person. Sometimes it's me and a group. But that's where we're going to be able to get like deal reviews if you have a deal that you want to review, or if you want to go over a specific what lender's telling you or a guideline or something like that. Yeah, it's going to be EST. Yeah. All right, so a DSCR loan is a real estate investing tool that real estate investors use in order to put permanent financing on rental properties without it affecting their personal debt to income, as well as limiting being able to close in a business entity. I butchered that one, but let's do it again. A DSCR loan is a real estate investing tool that investors use in order to put permanent financing on a rental property without it affecting their personal debt to income and closing in a business entity. That gives them a couple more specific advantages that uh, closing on conventional financing doesn't allow them to do. It does allow for a little bit more speed once they have the 20 to 25% down if they're purchasing, because they're not going through the full underwrite and proctology exam that a traditional bank or mortgage banker would require. They're providing the LLC documents, lease for the property, driver's license, voided check, and the purchase agreement. Anything else on the deal may be just deal or property specific. But what we're focusing on as brokers, and what I believe the DSCR loan's highest and best use is as a refinance, because it's still going to take 30 days. So you can't offer the same like speed to close as you would on a hard money loan. So the convenience piece is really just about uh, can you not qualify for conventional financing? Or do you not have the income to show it? Are you a business owner? So it's for real estate investors and business owners. You can get a DSCR loan on non-owner occupied properties, single family 1 to 4s, multifamily, commercial multifamily, and commercial properties. How do you pay it back? This is permanent financing. So this is the same way that you would have it as your your 30-year fixed mortgage that you would have on your house. You're building back equity in the property every payment that you make. It's a lower interest rate than the hard money side, but it's a little bit of a higher interest rate than the conventional financing. So if you're consulting with somebody and they're looking to buy a second home, or they're looking to buy a vacation home and they have the income to qualify, definitely let them know, hey, this is a little bit of a higher interest rate, but if you want to have this as a short-term rental and you don't want this to affect your ability to purchase another home, this is a great alternative. It does require 20 to 25% down towards the purchase price when you're using it as a purchase loan. So you have to be working with somebody that's well capitalized, a business owner that's profitable. Let's say it's the concrete business owner. He's got a lot of profit in his job. He's looking for ways to reduce his taxable income. So he has the 20 to 25% down every few months, and he wants to go and buy a rental property. The advantages to him is that he can depreciate the property. He's got the 20 to 25% down. This is something that's not affecting his personal debt to income. So if he wants to go buy a primary, it's not going to affect that. It's not going to affect him going to buy a car or getting any other types of loans. There are prepayment penalties on the DSCR loans. And that is a toggle that we can switch on and off in order to affect the interest rate. You can see that better in the RCN calculator portal, which we'll get into later this week. Because reminder, your assignment today is to get with that exclusive lender guide, go to the hyperlinks, sign up for the broker program. The goal of this week is for me to empower you guys to go and start this business on your own and help you take the first steps necessary. These are typically amortized over 30 years. You can see them as 15 or 20 or 25, but those are more on the commercial asset side. So if they're buying an office building or a light industrial warehouse or something like that, a DSCR loan will be on that. The letter salad's going to be the same. Loan to value and loan to cost are the same, but the loan to cost is going to be that purchase price versus the appraisal value. The appraisal value can come in higher than the purchase price, and then you'll have to default to the loan to cost towards the purchase price. For an example, okay? Say you're buying a turnkey duplex, so it's rented out. You're under contract for 250,000. Loan to value guideline is 80% loan to value. So your max loan amount is 200,000. Quick math, that's a $50,000 down payment. Okay. But the appraisal value came in at 225,000. Okay. Well, it's still going to be an 80% loan to cost. So their max loan amount is 180,000 against their $250,000 initial purchase price. Now they have a $70,000 down payment. You guys see that so far? Now you don't get that same benefit when it goes the other way. When you're under contract for 250,000, it's still going to be an 80% loan to purchase. Okay, you're still going to get that $200,000 loan to purchase, even though it appraises for 300. They don't get the 80% loan to value and then have to bring nothing to the table. A lender's always going to want to have the borrower have skin in the game when they're using a DSCR loan to purchase. In the case of the refinance, which is what we're focusing on, that property's worth 250,000. The max loan to value for a rate and term, which means that you're just replacing the loan that's already there. So if we got a hard money loan for 175,000, 250,000, that'd be a 200,000. If we have a $200,000 hard money loan on there and the borrower's not looking to pull any cash out, they just want to pay off the hard money loan, we can do an 80% loan to value rate and term, and they will have to come out of pocket for points, fees, closing costs, etc. But at least they got the hard money loan paid off. If they're looking to pull cash out, Kiavi does allow for an 80% loan to value cash out. However, they got to have 740 credit or higher, and we still have to meet that DSCR loan requirement or the DSCR requirement, that 1.15 or higher. Otherwise, we're looking at a 75% loan to value cash out max. So if the property appraises for 250,000, most of the time for nearly all scenarios that you're going to run, it's going to be a 75% loan to value cash out. Loan amount would be 187,500. We're hoping that when they bought the property at such a deep discount that when they fixed it up, now that it's worth 250,000, that 187,000 pays off the hard money loan, and they may be able to put some additional cash back in their pocket over and above what they paid for it. That's the power of the BRRRR strategy. And throughout this week, we're going to be doing BRRRR strategy scenarios. Okay, we got 5 minutes left. We're not quite exactly where I wanted to be for today's today's call, but I want to make sure that for the last 5 minutes, you guys get an opportunity to ask any questions either about what we've covered today, what we're going to be covering this week, and anything else in your real estate world.
Gary, can you drop your email address again, please?
Yeah, for sure.
Hey Gary, you
Yep.
mentioned, I might have missed it, but you mentioned where you you recommend charging at least 2,500 on a.
Yeah.
So what about on the DSCR loan? How do you?
Same thing.
Same
Same
thing.
thing.
Okay.
What's good about the partners that I'm trying to hook you guys up with,
Mhm.
Easy Street Capital and oh geez, did I just send that to you, Michael? My bad. Okay. So what's good about the partners that I'm trying to hook you guys up with, Kiavi and RCN, they are at a base of 0 points for origination for their DSCR loans because
Okay.
they're making more of a margin when they sell the note. And so they're
Okay.
okay with brokers grabbing origination. When borrowers go direct to them, they still have a 1 or a 1.5 origination point on their direct loans. RCN sometimes is at 0, depending on the deal. Where do I find the links for today's assignment? So uh, here we go. You're in the school group. This is where when you log in, you'll be brought to the community. Next, you'll go to classroom. Down here in the loan broker mini course, you go to a loan broker bootcamp day 1. This is the study guide. This is where I'm trying to hold myself accountable of what we're going to be able to cover throughout this week. Then here's the exclusive lender guide. It's also the pinned post in the community. And so here are the hyperlinks to Kiavi, and then also the templates that they're going to provide for you. But I want to get you that so that we're all using the same tools. This is for Easy Street Capital and for RCN Capital. So I showed you where it's going to be for Kiavi, but on here for Easy Street Capital, this is you want to click on the broker section, and then there will be a registration form here at the bottom. What's going to happen is you're going to be assigned an account executive over at these lenders. Um, it may be the same account executive that I have, but you guys, the goal here is to empower you guys to have your own relationships. And, it's important for you, but at the end of the day, if you see this opportunity as something where you're just adding in another income stream to your business, because you complete the boot camp this week, you'll be eligible to use my processors to close your deal. The reason why I'm showing you these lenders is because my processors are already trained to work with these lenders and can review the documents quickly and get you an answer as to, hey, we need to grab this, we need to grab this. This deal doesn't make sense for this lender. We need to go with this lender, and we can get you a faster answer. This business, as being brokers, we're going to win a lot of deals just based off of speed and being over the top communicators. Obviously, when we close, then we're looking to earn referral business. And so having a processor that's on their shit and doesn't miss is extremely important to making sure that there's not any delays in closing, which is delaying you getting paid. We got a couple of minutes here. Any other questions? No? Okay, so today, assignment is to go and get the exclusive lender guide. If you haven't already gotten access to the school group, please email me. I will get you into the school group. Um, and then tomorrow, we are going to cover. So what did we get done today? We got loan brokering covered. We got hard money loans covered. We got DSCR loans covered. If you guys feel like you're not like we went all over the place and you didn't know anything, it was hard to follow as far as the hard money guidelines and the DSCR guidelines in the school group. In the school group, back to the classroom, the hard money DSCR loan basics course is where I outline everything in more detail. Okay. Now, this is something that I didn't say on the webinars, but everyone here that is on the boot camp is eligible to schedule a one-on-one call with me to go over anything that they want within a half-hour period. And if you have a deal ready to go right now, we can go over that as well. I do have, the one-on-one coaching program, which is, this is the intro to that. If you guys feel like you want to take the next step and work with me one-on-one later on this week, we're going to talk about what that actually looks like and the benefits of doing so. But everyone here that is on the call, you guys can book a call with me. If we need to iron some things out or if you want some clarification, shoot me an email. We'll book a time to do that. All right, guys. We're tight now. Hour in. Hopefully you guys feel more empowered and better than you did and have more knowledge than you did before. See you tomorrow. Peace.